But my bottom line is gold is a bull market. It's overdue for some bucking, which means it might drop to $2,400 an ounce. But I think it's just a matter of time it gets to $3,000. Remember when 2008 hit, gold was up about $1,000 an ounce. It dropped to $700, and then it rocketed towards $1,900 by 2011. We have risks of hitting stops in gold as people, have to sell what you can. But that would be a short-term blip for a longer-term bull market if it happens. So you have to be aware that if you're looking to get way overweight long at gold at these levels, you have to be aware of a little bit of liquidation risk. But overall, to me, the trend is quite bullish. It's kind of things you expect in a bull market.
Commodities have experienced a wild ride in recent weeks. Spot gold surged past $2,630 per ounce, reaching new highs, while oil faces a different challenge, hovering around $71 due to weak demand from China. Adding to the volatility, the Fed's latest 50 basis point rate cut has introduced further uncertainty. Is China's economic slowdown the anchor weighing down crude? And with the Fed continuing to ease, how will commodities react as we approach the final quarter of the year? To break it all down, we have Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. McGlone offered insights into gold's record-breaking rally and the continued struggles in crude oil. He highlighted that crude oil recently dropped into the $60 range, reflecting a 20% decline over the past year, while gold has surged nearly 35 to 40% in the same period. McGlone expects this trend to persist, primarily driven by global dynamics, especially China's economic conditions. Several months ago, it seemed easy to dismiss a prediction like Bloomberg Senior Commodity Strategist Mike McGlone's that it was only a matter of time before gold hits $3,000 per ounce as hyperbole. But as the yellow metal continues to hit new highs and surge into a bull market, others are starting to jump on the bandwagon. Despite the bullish outlook, McGlone warned of possible short-term risks. He mentioned that if the U.S. stock market faces any setbacks, especially with the upcoming election and potential political unrest, gold could experience some downward pressure, potentially dropping to $2,400 before rising to $3,000. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
I look at it as a high price cure. It's basically about gold beating everything. You mentioned crude oil. Crude oil's had a decent dip into a 60 handle, down 20% on a one-year basis. And crude oil's up about 35%, almost 40% on a one-year basis to September, 23rd. And that's a trajectory I expect to continue. And I think the bottom line is it's really what's happening on a global basis is China. The Chinese government 10-year yield at 2.04% is 170 basis points, below the U.S. So is severe deflationary forces out of China. And you mentioned the Fed has started to ease. The good news is that might be good, but typically it's bad. If you look at the history, just look at the last time the Fed started an easing cycle, it was actually 17 years ago on September 18th. And a year after that, gold was up 20% and the stock market was down 20%. So hopefully it's different this time. Yeah, so you've seen that. The managed money net positions, hedge funds and futures are about 40% net long, which compares that to the peak in 2011, which is 49%. So they're very long. But they're on board and they're about as sold out in crude oil as they've ever been, petroleum futures. But that's the trajectory. The key thing that's happening, I think, in gold is gold ETFs, which have been in pretty significant outflows since that peak in 2020, about 30 million ounces of outflows. Now it's turned back upward. So we might see a little bit of excesses in the hot money, which makes sense. But there are excesses in terms of where the trends are going. That's gold going up, crude oil going down. But I think the key risk we have now is this rapidly advancing U.S. stock market just having a little bit of back and fill. And we do have an election coming up, and it's not for certain that it will be that clean and clear. Remember, the contender has never really accepted the last election, and there was some violence and insurrections after that attempt for a peaceful transfer of power. So the market might be pricing a little bit of that in. But my bottom line is gold is a bull market. It's overdue for some bucking, which means it might drop to $2,400 an ounce. But I think it's just a matter of time it gets to $3,000. And I'll end with this. A key thing and key fact about when you enter potential recessions, and particularly when you have extremely inverted yield curves, I look at the 30-year bond versus the T-bill, still very inverted. And typically when you have gold that is such a premium, the stock market, S&P 500, such a premium to gold. Just put the per ounces of gold on the same scale as S&P 500, which is basically it takes 2.2 ounces for gold. Historically, that's one over time. When you have such a premium in the stock market, they just kind of typically invert. I think that's what's happening. We just haven't seen that weakness in equities yet. If there's a bit of a risk, like remember when 2008 hit, gold was up about $1,000 an ounce. It dropped to 700, and then it rocketed towards 1900 by 2011. We have risks of hitting stops in gold as people, have to sell what you can. But that would be a short-term blip for a longer-term bull market if it happens. So you have to be aware that if you're looking to get way overweight long at gold at these levels, you have to be aware of a little bit of liquidation risk. But overall, to me, the trend is quite bullish. It's kind of things you expect in a bull market.
The U.S. Federal Reserve cut rates last week and could introduce more cuts over the next year, which could weigh on the dollar, making greenback-priced metals cheaper to holders of other currencies. Copper rose as investors anticipated a potential stimulus from China, along with boosts from central banks beginning their easing cycle. Copper prices have risen 6% year-to-date in 2024, driven by tight mine supply and challenges in refining. 3-month copper on the London Metal Exchange was up 1% at $9,647.50 per metric ton, after hitting its highest since July 18th at $9,649 earlier in the session. The most traded October copper contract on the Shanghai Futures Exchange climbed 1.2% to 76,310 yuan a ton. Analysts at Bank of America are projecting copper prices to rise above $10,000 per ton by 2025. McGlone noted that while copper reached a new high in 2022 during Russia's invasion of Ukraine, crude oil did not, indicating that metals may continue to outperform fossil fuels. However, with China grappling with a property crisis and numerous countries distancing themselves from its economy, McGlone believes the risks for copper are skewed downward. Let's shift our focus to a video.
U.S. unemployment rising, interest rates declining, the inverted yield curve and disinverting. Those are really bad signs for copper. And then the bottom line I like to do, if you just take that per pound price of copper, $3.35 a pound, and overlay it, the U.S. 10-year note at 373, it implies the copper price should be below 4, around 373. And if you add the Chinese 10-year note 2.04, whoa, you have closer to 3. So copper is very closely correlated oftentimes with interest rates. And interest rates are declining, bond yields are declining for a reason, because they're sensing deflationary forces. And to me, on a global scale, that is where commodities are clearly, there's no doubt, pointing out the trend is towards a global recessionary, deflationary contraction. And just look at gold's up 35%, 37% in 1 year basis. The Bloomberg Commodity Index is down 2%. Crude oil is down. Iron ore is down. The grains are down. Natural gas is up. So that you need something to change. And I don't think things are going to change overnight in China, meaning some kind of, yes, so we fully expect fiscal monetary stimulus, fully expect them to buy more of their equities through ETFs. But it's the macro that matters. And that's why I keep focusing on the next key shoe to drop, I think, for all commodities, all risk assets, is we just get a little back and fill beta, means the U.S. stock market, which is normal as you approach a contentious election. And when you're really stretched, just a little normalization. To me, that's the next trigger I'm worried about. And that's why I think copper is more likely to head towards $3 a pound than go up towards above 5. But to me, the way you started that segment there, I think is most important. The U.S. stock market cap to GDP is 2 times GDP. About $60 trillion is the stock market cap. That's the most in about 100 years. It would be silly to think that's not the most significant factor in inflation or deflation. There's a relative upward movement or downward movement of the U.S. stock market. So when I rope in copper, copper, let's point out some of the bullish points about copper. Copper made a new high in 2022 around Russia's invasion of Ukraine, and crude oil did it. Copper made a new high this year, and crude oil didn't. So I think it shows you the tilt. The metal is probably going to continue to beat the fossil fuel, but in the macro, it's stuck right in the middle there. And when I look at bond yields in China plunging, and all the data I see in the terminal about the property crisis, and every country in the world doing everything they can to get out of China, and NATO's comment that President Xi was a significant enabler of the war in Ukraine.
The commodities sector is on track for its second consecutive weekly gain. After an early September energy-led slump, the Bloomberg Commodity Total Return Index has rebounded sharply, hitting a 2-month high. Gold's record-breaking rally shows no signs of slowing, bolstered by the U.S. rate-cutting cycle, which historically leads to substantial gains in the following months. Spot gold surged past $2,600, marking a year-to-date increase of over 25%. Meanwhile, a weaker dollar is supporting a recovery in industrial metals, and silver is once again outperforming gold, pushing the gold-to-silver ratio back below 84. The question remains, how long can this momentum continue? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.